Hi, this is Dan Collins coming to you live from Traders Expo New York, and joining me is Michael Rulle from MSR Indices.
Thank you for having me, Dan, and it's a pleasure to be here.
Michael is speaking at the event here today, and a lot of it is due to a white paper you wrote about a year and a half ago on target volatility, where you realized that where a lot of the alpha, where a lot of the returns of long-short hedge funds were coming from, weren't necessarily where people thought they were coming from, right?
Yes, that's the short answer to that question is yes. What has been interesting, if you look over the last 15 to 18 years, as the hedge fund industry has grown, the hedge fund indexes are more and more like equities, and you can almost look at them as non-investable equity replacements. So we started analyzing that notion, and without getting into too much detail regarding that, we also observed that even though the total returns of hedge funds, equity hedge funds, were lower than the market averages, their risk-adjusted returns were higher than the market averages. Now, some people would rather have total returns than risk-adjusted returns. That's irrelevant. So we tried to assess to what extent, why was that happening? Because it was my belief, or my bias, I'll call it that, that stock picking doesn't work. On average. That doesn't mean there aren't great stock pickers. And so we used our one of our indexes, which, on our investable platform, which to test this theory, and we compared using a constant volatility portfolio of traditional equity indices like the S&P, the Dow Jones, the NASDAQ, and discovered that the correlation between them and hedge fund returns are very high, and the returns are comparable once you make fees, once you adjust for fees. And so we believe that target volatility equity portfolios, which will inevitably have much lower fees, are a great replacement, or certainly a portfolio addition to hedge fund or long-only portfolios.
So, I mean, what you discovered is that people can get the same returns maybe for cheaper. Is that, I mean,
for a lot cheaper, actually. The 50 basis points is what we assume we charge, and if you compare that to the hedge fund fees and you put them side by side and you look at the correlations and you try to figure out, is there any combination of those two things that'll beat the target vol strategy, you discover that the target vol strategy, certainly, I'm not saying it should replace, but it should be in addition to.
Yeah. Well, for the
actually,
average,
I would say it should replace, but I mean, I know no one's going to replace it.
Well, for the average,
in addition to.
Yeah. So for the average investor, what would you see how they adjust their portfolio based on your findings?
Well, you would call us. You could go to our website, msrindices.com. You can download our software, and you can give us a phone call. We can help you through that process.
And you can get the returns that many people are charging 2 and 20,
yes.
Sometimes
and
2 and 25.
We can demonstrate that. In fact, as you mentioned, I'll give you a presentation later that shows that, and we wrote a paper on that as well.
All right, well, we're going to take a quick break, and we're going to be back with more with Michael Rulle live at the Traders Expo New York.